We'll move on to our policy or our panel on monetary policy. So I'm Christina Romer, and I have to say I'm just so delighted and honored to be chairing this panel. I've also been thinking that this is just exactly the right role for me in this group because, unlike the rest of you, I wasn't technically a Stan advisee. We actually, the joke in our family, my husband and I didn't want to have the same advisor. So we used to tell people we flipped a coin to see who got Stan. Now, the truth is, Rudy was a wonderful fit for me. And of course, if you have one of the team, you got a lot of care from the other of the team. The other thing to say is that Stan was incredibly important in the lives of people like me who weren't his advisees, that he served as an informal advisor, and certainly he taught me graduate monetary economics. And of course, he's been a mentor and a model throughout my career. And actually, I'll just tell you one story about just how influential he was in my or our research career. And it comes from, I think, the very first day of Graduate Money, when Stan, in his own way, kind of looked around the room and said, how do we know that monetary policy matters? And we were all trying to be young and spunky and, cite Chris Sims and this regression and that regression. And Stan said, no, it's Friedman and Schwartz. That it wasn't some regression, some empirical test, it was the narrative analysis. And those of you who know how we've spent our life realize that we've spent most of our career pursuing that insight that Stan gave us on the first day of money. Well, as Jim already has told us, Stan's contributions to monetary economics and monetary policymaking are just simply enormous. So as a researcher, he very much helped to forge new Keynesian economics. Back when he was starting his research career, the rational expectations revolution had really thrown macroeconomics into a tizzy. And one key conclusion of that was that monetary policy didn't matter. And Stan realized that revolution had in fact slipped in another crucial assumption along with rational expectations, and that was perfect price flexibility. And so in his path-breaking paper, Long-Term Contracts, Rational Expectations, and the Optimal Money Supply Rule, he showed that you can provide micro foundations for price stickiness. And with that addition, even with rational expectations, monetary policy most definitely has real effects in the near and medium term. And that really set the stage for the model that is still the central model that macroeconomists use today. The other piece of Stan's research career that I think often doesn't get enough emphasis is the empirical side. He himself did important empirical work on topics like the cost of inflation or the relationship between inflation and relative price variability. But I think more important, he valued and encouraged empirical work, that any theory should have an empirical element or should stand up to empirical scrutiny. Now, of course, Stan's own research was actually just one part of his contributions to monetary economics. He was, in addition, just an extraordinary policymaker. And you can start with his time at the IMF when he helped to navigate the world through things like the Russia crisis. As governor of the Bank of Israel, he steered Israel through the financial crisis with both skill and tremendous success. And then he was pressed into service yet again as vice chair of the Federal Reserve. And I know that's something Bill will talk about and give us a sense of what he was like in that role. I think something that is just so incredibly important is how widely respected Stan was among the international policy community. When Stan Fischer talked, people listened. When he wrote about what policymakers should do, people listened. And then finally, if you're doing the tally of all the things that Stan contributed, you have to remember just what an amazing teacher and advisor he was. And I don't think it's an exaggeration to say that his greatest contribution to both monetary economics research and policy were the students that he produced. The people in this room, the people that we're going to hear from over Zoom. That he has, that his students took the insight that he had about blending rational expectations and micro foundations to new heights. They're the ones who built the new Keynesian model. Importantly, Stan just trained an entire generation of macroeconomists to actually be flexible in their views, not to be didactic, not to think that we already knew it all, but to actually have that flexibility, look at new ideas, figure out which ones we wanted to incorporate in the model, and again, to insist on empirical evidence to back up those theories. And then, of course, we know that his students have run central banks, advised governments around the world. But I think you need to realize just that through that service, he has had an incredible effect on the world, on 6 billion people. Right? The world is a more prosperous place, a more secure place, less prone to downturns and inflation than they once were. All right, well, with that as just a sense of how incredibly important this wonderful man was, I want to turn now to our distinguished panel. And like Jim, I'm not going to bother to introduce them. You know them. But let me start by asking Ben Bernanke to come and give a few opening remarks.
Thank you. I guess the Fischer Friedman-Schwartz Chicago connection is stronger than I thought, because when I was a first-year PhD student, I went to Stan. I had taken his course, and I said, I'm thinking of majoring in, concentrating in monetary economics. What do you think? And he said, well, I'll tell you what. Read Friedman and Schwartz. Either it will bore you to death, or you'll love it, and that will tell you which way to go. And I really thought it was interesting, and I've been interested in the Depression ever since, and that was it. The other, I've interacted with him in basically all his roles, but also as a policymaker, you mentioned his stewardship of the Israeli economy during the financial crisis. He got a couple of calls from the United States too, I have to tell you. And here I am, 55 years old, I'm still getting advice from Stan Fischer. So, but really remarkable, and of course, a wonderful person. Now, one of his things that he liked to talk about, and he'd written about, and he gave speeches about when he was a policymaker, was central bank independence. And he helped us. He made a very good heuristic contribution when he made the distinction between goal independence and instrument independence, which is a very easy thing to explain. So what I'd like to do is talk about independence. I'll start with the sort of the easy case, which is the rate setting case. But I want to look at some of the other things the Fed does, like bank regulation and balance sheet management, and ask the question, what can we learn from this kind of thinking about the independence of the Fed in those other activities? And this is an issue, of course, that is very hot at the moment, because we'll be seeing a new regime, and there's been a lot of discussion about changing the way that the Fed, Fed makes its decisions and who it consults with. So on rate setting, we all know the simple model is basically a principal agent model with time consistency problems that was, trying to create a way to avoid short-term inflation. This was the Kidlin-Prescott, Barrow-Gordon, Rogoff, et cetera. And basically the idea, of course, is that if you tie one's hands, you can get more credibility, you can get better outcomes, and you can, in fact, if the public believes you, you'll get, inflation expectations will be stabilized, and that will help you get better outcomes. Now, the other thing I should mention is, these principal agent models don't often focus on it, but the other part of this is technical expertise. And I don't do my own plumbing. I hire a plumber, and I hope that the White House is not telling NASA exactly how to build its rockets. I hope that they're leaving that to some people who know what they're doing. And so the same thing should apply to some extent to monetary policy. And obviously this principal agent model rationalizes the goal versus instrument independence. The goal is the principal's goals, and the instrument is what the agent does. But now the question is, how far should this independence extend, and what kinds of modifications might you make? So let me talk for just a couple minutes about bank supervision, which is something that the Fed has been doing since it was created in 1913. Clearly, in bank supervision, that obviously we can see that it is in fact the prerogative of the Congress and political leaders to set the goals. What are we trying to accomplish? And indeed, legislation about bank supervision will also sometimes give some technical guidance as well. What kinds of, how we want to treat different banks of different sizes, how we want to handle capital, et cetera. And then what the supervisors do is sort of the more low-level work, so to speak, of applying and interpreting the rules that come out of this process, and then doing the actual supervision, going into the banks and making sure that they follow the rules. Now, I would argue, and this seems to be not a popular view, at least in the Supreme Court, but I would argue that the principal agent time consistency argument works just as well for bank supervision as it does for monetary policy. And if you think about it, there's a strong time consistency problem. If you allow banks to be less safe, you get short-term political benefits. You help out the banks, you maybe get a little extra credit extension and so on, but then you're increasing the risk of a long-term financial crisis. And so to guard against that, you would think that the same kind of commitment would be useful. Also, of course, there's technical and informational advantages of having agents in this case. And I would add that more so than in monetary policy, that having an agent under some circumstances can reduce the risk of corruption and favoritism. If the agent doesn't get the benefits of the favoritism, for example, or if the agent is more easily examined and fired, if they commit corruption, then perhaps this principal agent model is the right model for bank supervision. Now there's another question though, is that should that supervisor be the Federal Reserve? And that isn't, I think, entirely obvious. There's certainly some positive complementarities between bank supervision and monetary policy. Monetary transmission works through the banking system to some extent. We need to understand that. The Fed looks at banking conditions to try and interpret what's happening in the economy. The Fed, of course, was created in large part to serve as lender of last resort, which in turn means you have a discount window. You need to understand if the banks are healthy or the ones who are coming to the window, what's happening there. So there are some obvious complementarities between bank supervision and monetary policy. On the other hand, there are some counter arguments. One of them is institutional focus. Can the Fed, give all of its attention to both these two different kinds of activities? Are there conflicts? Some people have argued there are conflicts between regulatory goals and macro goals. Should I lower interest rates to help the banks, or should I lower interest rates to raise interest rates to reduce inflation? There's an institutional problem, which apparently is going to be real now, which is that apparently the Supreme Court is ruling that governors can only be fired for cause, monetary policy governors. But if a governor is both a monetary policy maker and a bank supervisor, you have a potential problem. Could I fire a Fed governor because I don't like their bank supervision activities? And I think that actually raises some legal questions. So what should we do? We need independence of supervisors. The Fed may not necessarily be the ideal agent in this case. I think one solution would be sort of a compromise where there is an independent supervisory agency that has these independent features, but the Fed is highly engaged with that agency, and it has full access to information, is not making the supervisory decisions, is not deciding that Silicon Valley Bank should do this, that, or the other, but is very involved in the informational aspects. And that would be one way of thinking about it. This is sort of like what's happened in the United Kingdom, where they at one point had a central bank doing the bank supervision. Then they split off regulation in central bank. That was a disaster. So now they have this compromise situation where within the central bank there are two separate committees, one which is for monetary policy and one which is financial stability. But I think this raises interesting questions about how you should best manage the bank supervision. And I would just make the general point that I think there are more circumstances than just monetary policy where this time consistency issue and principal agent model are relevant. The other activity I want to talk about is the control of the Fed's balance sheet, which has gotten a lot of attention recently. Now, balance sheet manipulation can involve fighting financial crises or monetary policy. I'm going to stipulate on financial crises that outside of monetary policy, there should be some cooperation between the Fed and the Treasury, et cetera. There are a lot of fiscal issues involved. There's a common interest in preventing a collapse of the banking system, et cetera. So I'm going to put that aside and just talk about the balance sheet as it relates to monetary policy, which is in several ways. One is, of course, QE and some other policies affect the balance sheet. And then under the current operating principles, which are very similar to those in other countries, the Fed is using what's called the ample reserves approach, which means they have to maintain a balance sheet of adequate size. So given that this is part of monetary policy, there's a sort of a prima facie argument that the Fed should have some discretion over its own balance sheet. But there are certainly some complaints about, we hear all the time about the balance sheet being $6.5 trillion. Let me explain to you why they're all, except for one, why they're all not worth paying attention to. The first one is the Fed's balance sheet is so enormously large that it's just unbelievable. Well, here are the ratios of central bank balance sheets to GDP for a number of countries. United States, 23%. UK, 29%. The Euro area, 44%. Japan, 105%. And Switzerland, that paragon of financial stability, 122%. So clearly the Fed is not a major problem in terms of the size of its balance sheet. Now, one thing you hear a lot is, oh, well, the Fed's balance sheet is so big, it's got too big a footprint in the financial markets. This means absolutely nothing. Is there not enough securities out there in the market that people can trade them? I mean, what happens when there's a financial crisis in the bond market? The Fed increases its balance sheet. So I don't think there's much to that. Another complaint is that the Fed, in order to run monetary policy with a big balance sheet, has to pay interest to banks. That looks bad. But of course, we economists know it makes absolutely no difference to the government's balance, to the government's budget constraint, because if the banks were not receiving interest from the Fed, they would be holding instead Treasury bills and receiving interest directly from the Treasury. Another argument is that the Fed's holdings of securities make deficits easier because Congress says, oh my God, this is a big opportunity for us to borrow, et cetera, et cetera. I'm skeptical. I see no evidence that small changes in the interest rate are causing big changes in congressional behavior. So am I saying then that there's absolutely no reason to worry about this? And I'm not. I think there is one argument that we do need to take seriously, and that is the fact that a large balance sheet does expose the Fed and the US government to capital gains and losses. Now that's because the Fed chooses what they call a WAM, a weighted average maturity of its portfolio. And depending on how interest rates move, that can lead to paper or actually real capital gains and losses. Now, one might say the Treasury does exactly the same thing. They have to make the same WAM decisions. But of course, the Treasury is responsible for fiscal policy, and so there is, I think, a case there. So I think that, and this is something I think that the incoming chair has talked about. I think there is some grounds. The Fed should maintain, in my opinion, independent control over QE, but it should be cautious about using it and be willing to talk to the Treasury about its plans and how to deal with this. And I think that's necessary because, if anything, if the Treasury gets sufficiently annoyed, it can undo whatever changes that the Fed makes to the aggregate WAM. Again, the UK is a potential example. The Bank of England has used QE, of course. In fact, it introduced QE on almost the same day that the Fed did in 2009. But it has consulted with the Treasury, and in fact, the Treasury indemnified the central bank for any losses that it might incur. I have one last suggestion on this balance sheet issue, which is that talking about how big the balance sheet is not the right metric. The right metric is the deviation of the balance sheet from WAM and from the Fed's balance sheet from the overall WAM of Treasury securities, because that is the measure of potential fiscal risk that the Fed's activities are doing. And in what we call a neutral situation wouldn't mean zero balance sheet, which should mean one where the WAM of the Fed is roughly in the same ballpark as that of the Treasury. Thanks.
Thank you. Our second speaker is Ricardo Caballero.
I do have some slides. Oh, there were. Okay, so my advisors at MIT were Olivier and Stan. I wasn't as lucky as many of you here because Stan left before I finished my thesis, which was a great transfer from academia to the policy world. Stan, in my view, was an economist. I teach for Team 454, which you may remember, some of you know, is the last quarter of the first year sequence, macro sequence at MIT. And what I do, I organize it around 12 little models. I call them pocket models, which I think are the models that a good macroeconomist should have readily available to first react to any new macroeconomic issue. That's very consistent with what I heard about Stan throughout the day. That's the way he used models. He was not afraid of using models, of understanding the mechanisms and so on. But he wanted to use them for some real world solution. And I realized in thinking about these notes that what to say today, and from hearing all of you, Greg before, Olivier and the like, that in a sense, what I've been trying to do for, 30 years or so is to make our students a little bit more like Stan. Okay, and I think if I've done that, I feel very successful, and it's a great tradition to preserve. For Team 454, by the way, the main topic of Team 454 is the role of financial markets in macroeconomics. And that's an area certainly in which Stan made enormous contributions, certainly as a policymaker and in very different parts of the world. But I think he already was working on this kind of issues even before he left for Policy World. And the very first paper I read of Stan, actually, when I came here, was a paper with Bob Merton. And the essence of that paper was essentially macroeconomists should pay much more attention to the equity market. There's a lot to learn from the equity markets, and it's central to what we do. Now, what I want to do today, since it's a panel on monetary policy, is to talk about that central role of asset prices in monetary policy. And this is not a very novel point. I mean, Keynes had it very clear many years back, and said there are not many people who will alter the way of living because the rate of interest has fallen from 5% to 4%. Perhaps the most important influence depends on the effect of changes in appreciation or depreciation of securities in the prices of security. So this is, monetary policy transmits to the economy not through the interest rate, it's through the impact on asset prices. And certainly the language of financial conditions has been creeping up in the speeches by the Fed and pressers and the like, and I have an infinite number of quotes from Jay Powell. Financial conditions matter to us because they are the main channel to the real economy through which our policy has its effect. Had I had more space in these slides, I would have sneaked in a Bernanke-Kuttner slide, in which he talks about the main channel through which monetary policy indeed affects the equity market, and through the equity markets, the rest of the economy. So that's all about the transmission channel of monetary policy. We have written extensively about that. But I want to focus on something very narrow today, which is using financial markets to measure the stance of monetary policy. And I think it's an increasingly important issue because, if you look at the wealth to GDP ratio in the US and in most parts of the world has increased dramatically over the 30 years. So nowadays, any change in valuation has enormous wealth effects and therefore even larger impacts than when Keynes wrote about the importance of asset markets on the things we macroeconomists and monetary authorities care about, which is the management of aggregate demand. Now, because of this importance, we have seen a series of what is called financial condition indices. That is, these are different attempts to measure the impact of different asset returns, recent returns, on aggregate demand. And, pioneers on this was Goldman, but now I've been told that, at the Fed, they got annoyed by having to cite Goldman for all these kind of things, so they created their own index of financial conditions, and that's what I'm showing you there. And it has a nice virtue that uses the weights, because what a financial conditions index is really a weighted average of recent returns of 7, in this case, asset classes: equity, housing, credit spreads, long rates, and a few other things. The dollar, certainly there. And what they do is they use the weights and the lag structure of the FRB US model, okay? And so this represents very much what their models tell them. And I want to highlight 2 things in that. So it's done in yield space. So when it goes up, it means financial conditions are tighter. When it goes down, financial conditions are looser. And in different colors, you see the contribution of the different asset classes to the different fluctuations in the FCI. And I want to highlight 2 things. The first one is that the dominant source of fluctuations of financial conditions in the US is the equity market. And that's not because it has a high MPC associated with it. It has the smallest MPC, but it's simply because it moves a lot more, okay? And again, remember, this is a 3-year weighted average, so it's not the movement in the last week, but it's a contribution of the recent history of equity market fluctuations. The second point that I want to highlight is that even though you can see the impact of monetary policy in different instances there, I mean, the case in point is 2022, you can clearly see that tightening was induced by the Fed. The Fed needed to destroy wealth because the economy was overheating. But the bulk of the fluctuations in financial conditions are actually not caused by monetary policy. So here we have this object, which is the main driver of aggregate demand, the object that the central bank wants to control, which is driven by forces that the central bank does not fully control, okay? And so then it becomes the question of relevance that I want to discuss today is, how do we know when these financial conditions are too tight or too loose? It's the same question we ask about monetary policy. How do we know whether this monetary policy is too tight or too loose? So you can ask the same question about financial conditions. And so we have tried to replicate the path of what people have done with interest rates. It's okay, let's try to construct an FCI star in the same way as people construct an R star. And so that starts always with some sort of IS, no? And you extract from the IS, what is the financial conditions that give you neutral, no? That close the output gap. I'm not going to tell you the method we use to extract it, but it's very similar to what people do with interest rate. One thing to observe, though, is that an IS with financial conditions on the right-hand side fits a lot better than one with interest rate gaps on the right-hand side. Okay, a lot better, an order of magnitude better. And so the output gaps that naturally come from looking at financial gaps are very correlated with the sort of the narratives of the time. If you look at the blue line there is the path of the financial conditions gap that we extract. No? So a positive gap means financial conditions are too tight or are tight. A negative gap means financial conditions are loose. And you can see sort of how this index is telling you sort of things that you know. That you can see that around the dot-com bubble, it was telling you all over the place financial conditions are way too loose. After the dot-com crash, it tells you financial conditions are too tight. And certainly in the financial crisis, it tells you financial conditions were way tight. And unlike what interest rate spreads suggested, it also tells you that it took a long time for financial conditions to normalize after the financial crisis. They remained on the tight side for quite some time. It also tells you, anticipated much more than interest rates, the tightening that happened in 21, 22, at the end of 21, 22. Naturally, because financial equity markets move very rapidly, way ahead of interest rate policy. Anyways, so we have created a little web page. It's called fcistar.org. You can download the data and whatever you want there. And this is essentially the output you'll see now. It's just fresh there. We'll put more things. Ben gave me a few ideas of what else to put in there. But what you see in the first panel is financial conditions, the one that the Fed team put together. That's the light blue line, I think. And then in dark is the FCI star. That's what we compute. And so we can see that in that history, financial conditions were very tight in 2022 and so on. The gap that's even clearer, but then it eventually sort of, by 2025, financial conditions were at about neutral, and the corresponding output gap is more or less the same. You had a very positive output gap during 2022, and eventually, it normalizes, and you have seen a little tick up towards the end there of the cycle. In fact, if you zoom in to the last year, you can see that very clearly. Financial conditions, we began 2025 with financial conditions that were tight, still tight, But then we've entered into loose financial conditions territory, and we have not gotten out of it for quite some time. And in fact, eventually, because we have been there in a persistent manner, you start generating a positive output gap. And you can see at the beginning of 2026 that we're beginning to open up a new output gap. Now, what about today? And I want to finish with this. Where are we at? No, so we update this estimates whenever we get a new wave of data. The last one we measured, the last one I showed you there, we had a financial conditions gap of minus 0.22. That is financial conditions that were loose by 22 basis points. Just so you get a sense, if this gap, you wanted to close that gap in one instant, and only with the equity market, that's equivalent to a 10% correction in the equity market. So that's more or less what you could have needed to close that financial conditions gap at that moment. What has happened since then? Well, financial conditions are, this is to Q1, 26 Q1. Since then, financial conditions, we don't have the new measure of financial conditions put together by the Fed, but if you look at all the other measures of financial conditions, they certainly have not tightened, and they're probably a little looser than they were at the end of Q1. On the other hand, financial conditions star have loosened. And the reason for that is essentially, I do not know whether they have loosened, but if you use the forecast by blue chips, for example, on GDP growth and core PCE from the nowcasting model of the Cleveland Fed, it tells you that you would like to have financial conditions a little looser than you want before. But it's still not enough to close the big gap and the gap. And so I think that from this perspective, at least at this moment, we have financial conditions start to lose. So I see no space for really cutting interest rate from this perspective.
Thank you. All right, and our last speaker is William English.
Very interesting work. First of all, I want to thank the organizers for inviting me to participate here. It's really a tremendous honor to be here with all of you to talk about Stan Fischer. I think my job here is to talk a bit about Stan as a monetary policymaker, drawing on my time at the board when he was there as vice chair of the board. Stan came to the board in 2014, and it really was wonderful for those of us who had the chance to work with him, and particularly for those of us who had been his students. Now, others have already made the point that Stan's research was crucial to the establishment of kind of the new Keynesian framework, the way macro modeling is now done. But for my purposes, the point I want to emphasize is that for Stan, the theory wasn't just about the theory. His interests were focused on practical policy issues. And for evidence on that, I point you to the chapter in his book with Olivier with the title, Some Useful Models. And so that chapter talks about the need to be eclectic, the need to make the right assumptions, simplifying assumptions, as people have talked about. Stan was a master at trimming back, simplifying to tell a clear and compelling story. Then the chapter goes on to the key question. How does a good economist know what model to use for the question at hand? And they then offer the answer by being a good economist. That to me sounds like Stan in my ear, and perhaps to you too. This is really the art of economics, right? It's particularly the art of using economics to help conduct policy in an effective way, and Stan was an absolute master at that. Let me go back for a moment to when I was a student at MIT. And Stan went off to Israel to work on their 1985 stabilization plan. And when he got back, he gave a talk to explain what had been done. And we students, well, I guess I should speak for myself. At least I was bowled over by how he used the models that he had taught us, and also a deep understanding of the institutional structure in Israel to design and execute a really bold plan that brought inflation down from several 100% to about 20%, very quickly and at really low cost. It took a lot longer to get to 2, but this was still a real break in the Israeli economic time series. It was a remarkable success, And it showed all of us here how economics, done by a good economist, really could help make people's lives better. And many of us wanted to follow Stan and do that. Let me turn now to 3 lessons about Stan's approach to monetary policy that I took from his time at the board. First, Stan emphasized the world is a really uncertain place. He was fond of saying, somewhat to the staff's annoyance, there's one thing we know for sure, our forecasts will be wrong. That was true, of course, but I think Stan saw that uncertainty more clearly than his colleagues on the FOMC. As you may know, the FOMC publishes 4 times a year a summary of economic projections. Each participant in the FOMC provides forecasts of output growth, unemployment, inflation. The SEP also asks, and what do you think the uncertainty is around your forecast? Is it greater than, about equal to, or less than the average over the last 20 years? If you look at the responses to that, the committee on balance takes the Lake Wobegon approach. Uncertainty is always greater than average. And that was not true for Stan. He really stands out if you go back and look. He generally indicated that uncertainty was about average. And from time to time, he even indicated that it was less than average. He was almost the only person to do that. But with his long experience working in economic policy and thinking about these issues, he understood that even the average level of uncertainty was huge and it had to be taken into account as you made your policy decisions. Second lesson, partly a result of the first. Also, I think of Stan's personality. He often urged, at least at the Fed, a cautious approach to policy. So, for example, in the fall of 2015, the FOMC was thinking about the first time they were going to raise rates after being at the zero lower bound for a long time. Some participants were inclined to balk, to delay a little further, to hope they could get a little more confident that growth would be sustained, to hope that they could get a little more confident that inflation would return to target. Stan pressed them to get on with it. The labor market seemed solid, with the unemployment rate near estimates of its natural rate, 5%, at that time. Inflation was too low, but it had been pushed down by a surge in the foreign exchange value of the dollar and a big decline in oil prices. Stan thought that they should look through these negative inflation shocks just as they would look through positive inflation shocks. And so with underlying inflation about 1.6%, that was pretty close to target. And he thought that they should get on with it. The situation was good, he thought, and the job of policymakers was to keep it that way and not to risk a bad outcome by pushing things too far. In part, he was worried about possible financial stability risks, and in part, he was just worried that there'd be overheating, that inflation would pick up. So he emphasized, not surprisingly, that the outlook was really uncertain, but also that policy would adjust over time in response to those surprises to the outcome. On the one hand, the natural rate of unemployment, he thought, could well be lower than estimated. That was actually his view. So inflation might end up staying lower for longer. He thought that was okay. You just raise rates gradually. And that is, of course, what they ended up doing. On the other hand, he thought labor markets were likely to continue to improve. And as that happened, there was a chance we'd move up the steep part of the Phillips curve. He was a believer in a nonlinear Phillips curve. So inflation could rise faster than anticipated. And he reminded his colleagues that not all shocks to inflation are negative. We will again see positive inflation shocks. We just don't know when. The final of my 3 lessons, again, probably related to uncertainty, is that Stan was not a fan of forward guidance. He thought that the central bank could easily end up feeling constrained and unable to do appropriate policy. It would be torn between doing policy that it didn't like or losing some credibility if it gave up on its guidance and went ahead with the policy that was called for. The Bank of Israel, understand, didn't use forward guidance after the financial crisis. That was not because unconventional policy wasn't needed. Interest rates got to very low levels in Israel, and the Bank of Israel did use QE. But it was because Stan didn't like the cost-benefit calculus for guidance. When the issue came up at an FOMC meeting, Stan was grudging. He said, yeah, they might use foreign guidance, but it should be carefully and expertly qualified. He really didn't want to be constrained later on if things turned out in a surprising way, which he thought they could. As you probably already noticed, these 3 lessons have been painfully relevant over the past few years. Surely even Stan would agree that the world has been unusually uncertain of late. And we've seen some big, persistent, positive inflation shocks, just as Stan worried and warned. And the Fed did indeed struggle with its forward guidance after the pandemic, likely contributing to the high inflation that we saw. Needless to say, we'd benefit from Stan's advice in this very uncertain time for the Fed and monetary policy. Short of that, we can be grateful for all that he taught us. Thank you.
All right, well, before we open it up, I'm going to take my prerogative and ask the panel a couple of questions. And the first is going to pick up on something that Ben said, but also very much something that Bill said, which is, I want to think about what comes next for the Fed. And we certainly, Ben, you alluded to some of the threats to Fed independence, the various court cases, things like that. I guess I'd like the panel's thought of, has there been significant damage to the Federal Reserve? You mentioned about the important role of expertise. Do we see a downplaying of support for expertise at the Fed? How about internationally? What's the Fed standing? So anyone want to, I won't ask Ben to wade in on, what's he think the next Fed chair is going to be like, but a sense of the institution and the challenges that it faces.
Well, the independence issue, of course, is a big one, and we'll just have to see how it's going to depend a lot on the personnel who are leading the Fed and how they react. So but I think for now, I'm fairly convinced that barring some shocking change in leadership, that the Fed is made pretty clear, and I see a lot of support in Congress and elsewhere for a independent Fed. Just one comment about the technical aspects. I mean, I'm very interested to see, frankly, what the new chair wants to do. He has expressed concerns about the data-dependent approach, which in his mind is too backward-looking, and wants to look at more anecdotal data, other kinds of data. And I think the Fed does do that to some extent. We've got the Fed has got the Beige Book and other mechanisms. Of course, Alan Greenspan, has been pointed out, was very good at that kind of thing. So, particularly in a world where we have, AI and many data sources from the private sector as well as from the public sector, I think that's the right way to go. And I think that's where the Fed is already in that direction, and we'll see what is meant by, taking a more anecdotal approach to data.
I'll just add, right, one of Stan's contributions after training all of so many people, so many of them then went to the Federal Reserve System. I always took a great deal of comfort knowing that there were many Stan students doing the forecast, guiding the actual policymakers. Ricardo, or
I'm gonna delegate on that.
you'll let the two Fed people.
So I think I'm agreeing with Ben. I feel less bad about Fed independence so long as the courts don't change the game. As you know, the FOMC includes the 7 governors. They're picked by the president, confirmed by the Senate, but they have long terms. And so if those folks more or less stay in place, this president gets to pick 2 of those 7. And the other 5 voters on the FOMC are Reserve Bank presidents. They're chosen by their boards. They have to be confirmed by the Board of Governors. But the president doesn't have a whole lot of control over the composition of the FOMC unless he gets the ability to fire people without cause, and then that's kind of the end, I'm afraid. But short of that, I guess I feel fairly confident that Kevin Warsh will come in. He'll have to convince his colleagues to make policy decisions. And I think he also will realize that he needs smart staff, he needs input from across the committee and so on to make good decisions. It's going to be his reputation on the line. So I'm reasonably hopeful about that, again, unless the courts surprise us.
All right. Well, you're certainly more optimistic than I am. But,
Well, tell
I
us-
will.
tell
I will
us.
sleep a little better tonight. Is that I think the huge caveat is that the courts don't step in, or you don't try to put Jerome Powell in prison, and then that's another way in which this can go south very quickly. So it's been terrifying, I think, to watch from the outside. The second question I want to ask actually picks up from actually the discussion in the previous panel, because the role of the rising government debt and its influence on the Federal Reserve. And I tell you, just this was an issue that was very dear to Stan's heart, because one of my most vivid memories of my short time in government was him coming to the Council of Economic Advisors in very early in 2009 and berating me about our budget deficit. So if ever there was a time I thought it was okay to have a budget deficit, it was them. But this was something that was very much in Stan's mind. So the previous panel was very worried about fiscal dominance and the possible role that the rising budget deficit could have on monetary policy. Are you more or less concerned about that?
I'm less.
You're less, okay?
I'm less, because I think that inflation is incredibly unpopular in the short run, and so it's very difficult actually for fiscal dominance to prevail in the short run, at least. Then we shall see. But politicians do respond to voters more than to economists, and I think that inflation is tricky at the moment. It's a big constraint.
So something David Romer said struck me hard, which is the Fed may have to try to make a decision about whether some problem in the Treasury market is because there's some temporary difficulty, in which case the appropriate thing to do is to step in and provide liquidity and maybe buy some Treasury securities and improve market functioning. Or it could be just investors really are backing away, in which case I think the right thing to do is a lot less clear. You don't do anybody a favor by having a big inflation problem on top of a big fiscal crisis. And so I think the really hard decisions that the Fed may face could easily be in this sort of situation where the Treasury market is a mess and long rates have gone up a lot, and it's clear there's some sort of problem. But then you've got to diagnose what is the problem, and therefore what do you want to do about it? And that could be really a challenge.
Stan and Rudy taught us a lot about more extreme cases. We studied Philip Kagan's paper on the Confederacy, and Israel was another example where fiscal dominance became, where the deficits got so large that only seniorage was the only way to try to make a dent. So I don't think we're, some people argue that we can explain the recent inflation with, I don't see that at this point. I think that there's still enough demand for treasuries given their special features, liquidity, et cetera. So I think we're still some distance, I think. Of course, as the first panel pointed out, we don't know exactly how far, but the dynamics at this point are still more like an advanced economy than like, a emerging market economy with an inflation problem. So I don't think it's here yet, but of course, there could come a time when that happens. But I don't, as an empirical matter, I don't think that inflation that we have seen up to this point is explained very well by fiscal dominance, and attempts to do so typically are very hand wavy. I mean, there's not a lot of real evidence that shows the connection.